you're looking to make money through investing, you have a ton of options. But finding what's best for you depends on your risk tolerance and personal preferences. While stocks are a popular way to invest, there are also other ways. With bonds, investors can make loans to companies and governments at the federal, state, and local levels for a decent but predictable return. Another popular but much riskier option is to invest in cryptocurrencies like Bitcoin. Index funds, another tempting option, let investors own a preset collection of stock or bonds, most often centered around a theme such as location, company size, or industry. There are two different types of index funds: exchange-traded funds, or ETFs, which are passively managed, and mutual funds, which are often actively managed. Let's chat through some of our options, starting with one that's pretty safe in terms of getting a reliable return. Let's bring back Mercedes to tell us about CDs.
A CD, short for Certificate of Deposit, is a type of account offered by banks and credit unions that offers an amount of interest in exchange for you committing to keep the funds in the account for a set period of time. These accounts typically pay a guaranteed rate of return and are FDIC insured, making them a very safe investment. CDs generally offer a better rate of return than traditional savings accounts, but they don't offer nearly as much upside as the riskier investments we'll cover in a bit.
And for people who want to earn more but don't want to deal with the volatility that comes with, say, crypto, there are options available.
Mutual funds and ETFs both fit the bill. An index fund is a type of investment fund, either a mutual fund or an ETF, that is based on an index. An index is a preset collection of stocks, and an index fund merely mimics the stocks in that index, rather than pick which stocks to own. As you mentioned, an index fund is typically created around a specific theme. For example, there can be indexes for companies based on their location, size, industry, or whether they pay dividends. An index might also consist of only bonds or only bonds of a certain quality and duration. While there can be almost any number of indexes, the most famous ones are those based on the Dow Jones Industrial Average, the Standard & Poor's 500, and the NASDAQ 100. Of these, the S&P 500 index has come to be seen as the bellwether for the American stock market. It contains about 500 of the largest companies in the US, and when investors talk about beating the market, the S&P 500 is considered the standard. In contrast, the Dow Industrial contains just about 30 companies, while the NASDAQ 100 contains about 100. While the holdings of these indexes do somewhat overlap, the S&P 500 contains the widest variety of companies across industries and is broadly diversified. Mutual funds and ETFs, which stands for Exchange-Traded Funds, are definitely similar in many ways, but there are key differences between them, mainly in terms of what they cost and how they're structured. Let's start with mutual funds. Mutual funds are managed portfolios of various types of securities. These funds combine investors' capital to buy stocks, bonds, or similar investments. These funds are overseen by money managers who attempt to earn high returns for investors. One of the primary advantages of mutual funds is that they allow individual investors to pool their money to create a diversified portfolio, even with a small amount of money. Just one share of the fund owns a stake in all of its investments, so holders get immediate diversification. However, mutual funds also often come with fees and administrative costs. Some may charge a sales commission of 1 or 2%, though many don't. And mutual funds often charge a management fee, on average more than 1% of your investment in the fund annually. Now, let's talk about ETFs. ETFs are a type of fund that own various securities, often of one type. One share of the ETF gives buyers ownership of all the stocks or bonds in that fund. For example, if an ETF held 100 stocks, those who own the fund would own a stake, albeit a very tiny one, in each of those 100 stocks. While many mutual funds are actively managed with professional investors actively trying to predict stocks that will rise, ETFs are typically passively managed, with the fund holding a fixed number of stocks based on a specific preset index of investments. As far as fees, ETFs are typically cheaper than mutual funds. All you need to pay is an expense ratio, which is the fee paid by investors for managing the fund. That's about 0.5% of your investment in the fund annually. Unfortunately, the popularization of cheap, passively managed ETFs has caused the expense ratio of both mutual funds and ETFs to fall drastically.
All right, let's move on to another increasingly popular, yet significantly riskier type of investment: cryptocurrency. Crypto is electronic only and appeals to many people because of its ability to be managed without a central bank. It's also very difficult to counterfeit. However, it's also known for its extreme volatility, with values of different tokens swinging dramatically, often on a daily basis. Let's see what Mercedes has to say about crypto.
Without getting too lost in the weeds, cryptocurrency comes to exist through a process called mining. Mining involves powerful computers performing calculations and processing transactions on a ledger. When miners do this, they earn a unit of the currency. The mining process requires expensive processing power and often a lot of electricity to perform these calculations, which creates a significant amount of pollution and waste. Because of this, crypto may not be the best fit for investors passionate about the environment. Now, as far as investing in crypto, the process is actually similar to buying stock. Many digital brokerages like Robinhood, Coinbase, and TD Ameritrade now have crypto exchanges that allow users to trade Bitcoin, Ethereum, and other digital currencies. Even PayPal has gotten into the act, allowing US users to buy and sell crypto. It's worth noting that many of the specialized crypto brokers or exchanges charge very high commissions, say 3 or 4%, or sometimes more. And you'll want to carefully check the costs for buying and selling because they can quickly eat up your gain, especially if you're only trading modest amounts.
Phew! What a great recap of popular investment types. Regardless of what you decide to invest in, keep in mind that time in the market matters more than timing the market, and having a diversified portfolio is paramount. Having all of your money in one type of investment is never a great idea. Keep watching to learn more about how to balance investing with your saving strategy.